Welcome back. In this video, we're going to talk a bit about margin. When you're running strategies with leverage, one of the decisions that you'll need to make is on the type of margin that you trade with, because it can change how the profit and loss behaves when you're not in a position. The first option is a stablecoin margin account. Most crypto exchanges use USDT or USDC. That means that your collateral is effectively in dollars. The dollar margin is the simplest to understand because your collateral is stable. So if you deposit $1,000 of USDT, that value doesn't move just because the market does. If you open a Solana trade and the price of SOL goes up and down, your trade position will go up and down as well. But in the background, your account stays anchored in USDT, which means that if the market's volatile or trending down while you're flat, your balance doesn't erode. That's why a USDT margin is the default for a lot of traders. It keeps things predictable, especially during choppy periods. Coin margin works differently because your collateral is the actual asset you're trading. So if you deposit Solana as your collateral and you're trading SOL, you're effectively holding SOL at the same time as gambling on it. That means that two things can happen at once. If the strategy makes money, you earn more SOL, and if the SOL price itself rises, the collateral you're holding becomes more valuable too. So you're effectively compounding the gains. If the underlying asset is trending upwards, your account can grow even if you're not in a trade. But the opposite is also true. When the market drops, your collateral value falls, even when the strategy is not in a trade. And if I've lost money on a trade as well, you can compound the losses as well as the wins. This is why margin has such a large impact on backtests and live performance. If the market's in a healthy uptrend and you're running a long bias strategy, coin margin can significantly boost your results. If conditions are uncertain, however, or sideways or bearish, USDT margin gives you far more stability and protects the value of your account when you're not positioned. So let's go back to the example of the Solana strategy that we've used throughout this tutorial, and look what happens when we switch the margin type. In one 6-month period, where Solana itself increased by around 26%, this strategy using a USDT margin returned roughly 180% versus dollars, and about 120% versus Solana. When I flip the margin to coin margin and run the same strategy over the same period, the same exits, same entries, same time frame, the underlying edge is the same, but the total return jumps to around 215%. So that extra gain is coming from the fact that we're holding Solana as capital. As the strategy wins trades, our Solana bag grows. As the market goes up, the value of the bag rises as well. We're winning on the trades and on the underlying coin. Now let's see what happens in a very different environment. If I take this 8-month window, where Solana fell roughly 27% from a major high, and rerun the same strategy, the picture's reversed. On the coin margin, the strategy still trades, it finds some nice profitable moves. It's actually 9% better than if we just held on to Solana, but it's still a net loss in dollar terms. If we flip this over now and use a USDT margin in the same window, same strategies, same results, but very different outcome. Because the collateral was stable and it didn't fall with the market, the strategy is now up about 40% versus dollars, and up about 93% over a buy and hold approach. So the lesson here is simple. In a bull market, coin margin can boost returns on long strategies because you're compounding both the gains on the strategy and on the underlying price appreciation. In a falling market, USDT margin can make more sense because it protects your base capital from the coin's downside while the strategy tries to extract alpha on top. There's no single right or wrong answer. What matters is that you understand the trade-offs and the risks, and that you backtest your strategies across a range of market conditions before you go live so you can make a fully informed decision. In the next video, we're going to talk about going live with your strategy. See you there.